Hello, chart watchers, and welcome to this Thursday, January 18th, Market Watchers live show with your hosts, Tom Bowley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Another exciting day in the market today. You can see here we've got an update. We've got the Dow Jones right now down 123 points. The S&P 500 down 7. The NASDAQ also down 7. The Russell 2000 down 7. So too bad we're not in Vegas today. We've got 7s everywhere. 10-year Treasury yield up, challenging that 260 level, currently at 2.605. And if you look back, it's been a while since we've taken out 2.62% to the upside. So that's going to be a level to watch, no doubt about it. Some of the interest-sensitive groups like the financials really move back and forth with that 10-year Treasury yield. So we'll want to keep an eye on that throughout the day. The volatility index continues to stay elevated. And when I say elevated, elevated relative to where we've been. We've been down in the 9s, maybe into the 10s. But you can see right now we are sitting just above 12. The volatility index is up slightly today. A couple of the areas that are worth mentioning, we've got the aerospace group, which have been on fire, actually down today. And you can see Boeing is the big loser in the Dow. We are down 10, almost $11 on Boeing right now. But that comes on the heels of a pretty strong advance. So just some normal profit taking. Also wanted to mention that the specialty chemicals having a particularly rough day today, down about 4.5 points, a little more than that, which on a percentage basis isn't that great. But the two laggards in the S&P 500 are within this space. Albemarle Corp, ALB, you can see took a big hit at the open, as did FMC Corp. Both of these stocks down quite a bit. ALB down $11, and you can see that FMC down about $6. And on the flip side, on the NASDAQ, we've got Viacom, VIAB, having a very nice day today, up $1.88. So that is up a little bit more than 5% on the session. And with that, I'm going to bring in my co-host, Aaron. How are you doing this morning, Aaron?
I'm doing just fine. A nice win last night. Ducks over the two-time defending champs Penguins so I'm pretty happy about that. And of course, a beautiful day. What can I say?
Yeah, I don't even want to talk weather. I'm getting tired of this. You know, I've been sporting shorts all winter long, trying to battle Mother Nature, and Mother Nature is definitely winning.
Yeah.
It's been a cold January here in South Carolina. I actually looked, and I know this has nothing to do with the stock market, but just a fun fact. I looked last year, and through the months of January and February, we only had 8 days where the highs were below 50. And so far, we've already had 13 this January. So it has been an unusually cold winter for those of us in the Southeast. But anyway, we're going to move on to the market. We do have Greg Schnell with us today. Greg, how are you doing?
I'm doing great. Thanks, Tom.
Yeah, you're not complaining about cold weather, are you?
No, I'm hanging my hat in Scottsdale, and it's a little warmer here. So yeah, it's beautiful.
All right, I'm jealous. Actually, I've been out there with Greg before, and it is absolutely beautiful. I think I was out there in February to join you a couple years ago, I guess, and played some golf, and the memories. Anyway, we're going to move on. We got a lot going on. Aaron, why don't you take over and go over the schedule?
Absolutely. On our upcoming schedule, of course, my workshop is tomorrow. I'm going to go over our DP market indicators so you can understand how they work. It is Chart Watchers weekend, so we're going to be releasing our Chart Watchers newsletter over email I think we'll send it out on Saturday or Sunday, and you're not going to want to miss that. And then our guest for next week is going to be Scott Carney from harmonictrader.com, I believe is the company, but he's a harmonic trader. So we're going to learn about harmonics and the stock market. For today's agenda, though, as Tom and we mentioned, Greg is here for a point and figure review. We have momentum sleepers as our second segment today, followed by, of course, the 10 and 10 to 1. And our very first one is going to be Beazer Homes, BZH. And then finally, we'll finish off with anatomy of a trade. And with that, we probably should get going here.
All right, sounds good. We got 10-year Treasury yield here on the screen. You can take a look at that while I go over some of the economic reports today. December housing starts came out, 1,192,000 units. The market was expecting 1,280,000 units. So we did have a little bit of a miss, or, well, rather significant miss there. But December building permits actually came in slightly above expectations, 1,302,000 versus 1,300,000. So a very slight beat there. Initial jobless claims came in at 220,000, way below the estimate of 250,000. And then finally, the Philadelphia Fed survey came in at 22.2. The market was expecting 25.0. So a little bit of disappointment there. So a mixed bag in terms of the economic reports, but the bond market responded about the way it's been responding, with another sell-off. So as the Treasury market was selling, that sends yield prices higher. Always get an inverse relationship there. So anytime we see a period of selling treasuries, we get the 10-year Treasury yield moving higher. The key here, though, as you can see on this chart going back the last 10 months, this is the highest level we've seen. I'm going to bring up a 5-year weekly chart just so you can see the significance here. We are right up against now a very significant, formidable resistance level, just about the 260 to 262 area, depending on whether or not you go with closes or intraday or intra-week moves. But here, the low 260s, clearly going back the last 3 or 4 years, has been a very difficult level to get through. We are in a bullish pattern, though, with a move straight up. Again, I think I mentioned this yesterday or the day before. You can look at this as a cup. You can look at it as inverse head and shoulders. Both are continuation patterns, and both normally resolve themselves with breakouts to the upside. And that's exactly what the Fed's telling us. The Fed's been telling us that they're looking to raise rates a few times in 2018. So it wouldn't be surprising to see that market begin to price that in. So the 10-year Treasury yield is certainly one area to keep an eye on. Then you've got the Dow Jones U.S. Home Construction Index. Of course, I mentioned housing starts came up short. Building permits were slightly above, and yet we moved to another high on the Home Construction Index. The thing that's most concerning to me on this chart, besides the fact that it's been a straight up move since back at the beginning of September, this index in beginning of September was down near 700. We just hit 1,000 today. So literally in 5 months, less than 5 months, we have tacked on about 40% onto this index, maybe a little bit over 40%. So it's been a huge, huge move in the home construction space. And the question for me is whether or not this negative divergence, higher prices, much lower MACD, whether or not this begins to play out. And by play out, what I normally see with negative divergences is ultimately a trip down to test the 50-week moving, 50-day moving average, and or a MACD centerline reset. At that point, all the momentum issues are gone. That's what the definition of a MACD zero test is. Your short-term and your moving and long-term moving averages are exactly the same. So at this point, I think the group is a little bit suspicious to me. I would be really careful in the home construction space. I think longer term, we're still fine. Again, and looking at this longer term weekly chart, if I pull this up, you'll see that we had gone sideways for a while. And really, this is the first year of what could be a multi-year move to the upside. But just take a look at the move since September and how overbought we are. Look at these blue mountains on the RSI. And I think what this proves is that overbought can become more overbought. We saw that back in October when we first moved into overbought territory, maybe even into September. But we've continued. Most of this move has been made with the RSI above 70. So if your sell sign is an RSI 70, then you would have missed the entire move to the upside. This is why overbought conditions, while they do present maybe a little bit more risk, they are not a primary indicator in my view. It does tell you that the market, for this particular area of the market's overbought, but you want to be careful making decisions solely based on the momentum oscillators. Semiconductors, I think this is a group certainly worth mentioning. You can see on the daily chart, they also had a huge move up from September through the end of November, but then we consolidated. You could call this a cup with a little bit of a handle, or you could call this equal highs coming across here with higher lows, printing an ascending triangle. But no matter which way you slice it, we did get a breakout. And while I would expect that the first area of support should be felt around 3,400, I think you also need to keep an eye on the rising 20-day moving average, which currently is sitting at 33.34. Those would be the two key levels that I would look for on any pullback in the semiconductor space. Some earnings news out today. Well, let's see. We had Morgan Stanley. Morgan Stanley reported revenues above consensus estimates and also came in with earnings 84 cents versus 77 cents. Got a nice pop, a little bit of a pop at the open today, but it has come back down, is only up fractionally now at this point. And with higher prices, we do have a negative divergence. So be very careful if we don't continue to extend this advance to the upside. If we were to come back down maybe and print some kind of a reversing candle, maybe a dark cloud cover, another bearish engulfing candle like the one we saw 2 days ago, I think that could be particularly bearish given the fact that the yield is, the 10-year treasury yield is hitting a major resistance level and a negative divergence here. And I should also mention the end of a historically bullish period in the stock market. I had written in the blog, and I think I've talked about it on this show a couple of times, that the S&P 500, the strongest period of the year, runs from the close on October 27th to the close on January 18th. Today is the 18th. And by the way, if the S&P 500 finishes above 2805 today, it will mark this current period, December 28th, 2017 to January 18th, 2018. It will mark this as a year within the top 25% of all of these periods dating back to 1950. And if you say, well, what does that mean? Well, historically, the best years from October 28th to January 18th tend to carry over their strength for the next 3 months. The performance over the next 3 months is much stronger for years that have been very strong heading up to January 18th than they are for years that haven't. I know, that kind of goes a little bit against common sense. You'd think that if the market's had a big move, it needs time to pause and consolidate and so forth. But that is not the history of the stock market. The history of the stock market is that when we see strength throughout this period, it tends to carry over another 3 months. And a close today over 2805 on the S&P 500 would set us up potentially for some additional strength here over the next few months, at least based on historical patterns. Not, obviously that's not a guarantee of future results, but history is a great teacher. A couple of other stocks, BB&T, another bank stock, 2.87 billion in revenues. The market was looking for 2.84 billion. The earnings per share came in 82 cents versus 80. But look at this candle right now. It's a lot of this was built in, and this is the part that the market, a lot of folks don't get about the stock market. But you can see that we had a really nice move up heading into earnings. And now we're getting these great results. And the stock was up a couple of bucks, maybe $2.50 earlier today. And we have completely reversed. We're up 1 penny. We've given it all back. So this is maybe a capitulatory type day. Volume's heavy. And unless we strengthen in the second half of the day, I'd be really careful in BB&T and probably in many of the banks overall. MTB, another bank, came out, beat top line, beat bottom line, and this one has continued to move to the upside, which is very good news. Their earnings were absolutely great, though. $2.66 was the earnings per share. The market was only expecting $2.40, so a huge beat there. Also, on the revenue side, M&T Bank had revenues of $1.46 billion. The market was only looking for 1.2. So really good beat top line and bottom line here. And this one hadn't gone up as much when you look at it as many of the other banks heading into earnings. So I think that's why we're seeing such a nice response here. Another company that reported, JBHT. This is JB Hunt, a transport trucker. And again, here's a stock that moved up into earnings, came out with better than expected results, revenues and earnings per share, slightly above Wall Street estimates, but yet we're down today. So maybe a lot of this has already been priced in. One notable stock maybe to mention that did come up short was BK. This again is in the banking space, Bank of New York Mellon. And BK came in way short on revenues, really a surprise considering how the stock had been trading heading into earnings. But 3.71 billion is what Bank of New York reported. Market was looking for 3.98 billion, and earnings came in exactly as expected, 91 cents. So no beat on the bottom line and a big miss on the top line. And this will kind of give you an idea of what might happen this earnings season if you fail to meet Wall Street expectations, because the expectations are lofty. And we've seen that with a huge run up in the U.S. market. Couple of upgrades, and then I'm going to turn it over to Aaron for some downgrades before we bring Greg in. I just wanted to mention two that I thought were kind of interesting. One is Palo Alto Networks. The stock had been sideways consolidating, came out with a really nice earnings beat back in November, gapped up, went back, filled the gap, and now came back up to challenge the high. Now they get the upgrade, and here is your breakout. We'll have to see. I'd like to see a little bit more volume coming in to support this move to the upside, and also a close near the high. So we'll want to watch for that later. And the second one is Pulte Homes. Given the home builder or the housing starts number out this morning, looks to me like this one's running out of gas a little bit. Big volume during this advance in October and November, as you can see. Volume's kind of been slowing down, though, recently, especially in the past week and a half. You've seen the volume really move down. Today, they get an upgrade, and they just can't seem to break out of this range to the upside. So I think this is another one I'd be careful about. I'm not going to bring the charts up, but 4 other companies that did have upgrades this morning that I saw: Floor Corp, FLR, Walmart, WMT, UBS, and I think it's Cognizant, CTSH. And with that, I'm going to let Aaron take a look at a couple of the downgrades out this morning.
All right. And I actually don't have my audio muted. So First Solar is the first downgrade. Let me go ahead and share my screen. And I'm looking at this one. Of course, let me get this. There we go. I'm looking at this one, and as far as a DP perspective, might not be what I'd want to do here. Why is this not working? Let me know when you can see my screen, but it's Zoom is not working.
I'm not seeing it yet.
Let's try the desktop. Okay.
There you go.
That one worked, but I'd rather do something different here. Let's go over here. Yeah, so the first one I am gonna look at, but obviously you can't see it just yet. All right, that should be good. All right.
Yep,
So
we got you.
yeah. So from a DP perspective, I probably wouldn't do much with this, just because you can see in the thumbnail that top below the signal line. So I don't like it. However, I mean, you could make a case for it. It's holding the 20-day EMA, and it's sitting on this support level right now. But again, if you look in the thumbnail, we're looking at a descending triangle. So, you know, it did get the downgrade. I wouldn't be looking for this as as something to get into. But you could make a case for it if you wanted to try and jump in off this area of new support per se. The second one I wanted to look at is SYMC, so we can see Symantec. On the downgrade today, not good. Got a gap down, and we're testing lows that we haven't seen in over a year because it's not even on the chart. You can see we had a PMO turn down below the 0 line and is now, logged in this PMO sell signal. But notice, if you look in the thumbnail, we were already getting some warning here that there might be a problem as the PMO had decelerated and looked like it might be turning over. So using the PMO, you probably would have been safe from this gap down and move. But yeah, this one doesn't look good. And, we do look at these downgrades as possible prospective investments, just because if you get that pullback on these downgrades, but the chart looks good, you could still make a case to get in it. So right now, Cardtronics, and you can see it's hit this area of overhead resistance, and it has turned back down. There are a few decent things about the chart. That 20-50-day EMA positive crossover would give me an intermediate term buy signal, but I would have probably stayed away from this one as well, because we have, though it's not overbought, the PMO's already kind of made its move. This one would have been a great one to catch back here and look at that really nice, strong PMO move, but price was mostly sideways. So that would have been a good entry at this point. Don't like it with the PMO that way. And finally, let's see, APPN, which is Appian. And I looked at this, and the first thing I saw was this giant flag. But this is awfully messy if you wanted to call that a flag. Here's the big problem, though. Overbought PMO. It is still trying to find its range, but we know, being this high, that it is overbought. So I would be staying away from this one as well, being as overbought as it is. But you can make that case for that flag formation, and it is holding the 20-day EMA. So there's some possibility here, but for me, I'd stay away. And with that, I'm all done.
Yeah, I think that was it for the downgrades. And I know we got Greg in here today, Greg Schnell, and always a fun day to have Greg with us. And Greg, from his sunny Scottsdale, Arizona place, is going to show us a little bit of point and figure. Go ahead and take it away, Greg.
Okay, can you guys see the screen there?
Yes.
Yes.
Okay, perfect. So we're going to start off. I covered off the CRB the point and figure charts for the indexes a couple of weeks ago. And so this week I wanted to do the commodities. And what we want to cover off specifically is just there's kind of a mixed, the agriculture area isn't doing very well, but everything else is doing quite nicely. So what we'd like to do with the CRB is just get a big picture view, and the Commodities Research Bureau is what the CRB stands for, and there's 19 commodities within it, and energy makes up 38%. So if the CRB is going up, usually energy has to participate. But what we could see here is this is 2018, and again, just a review for everybody. On these charts, the numbers represent the month that they went through that price point. So this was January 2017, February, March, April, May. And if one number's missing, it's because the chart didn't move enough that month to make a change. But A, B, and C is October, November, December. And now we can see that we're up here at the very top here in January. And a year ago, we kind of had the same thing going on with the CRB. So the important thing here is that we're at this level 196.40, and we're on a buy signal, on a PnF signal, and we haven't been for 6 years. So that's a beautiful story to finally change that trend. And we've got a target up here at 224. It's actually a bullish price objective up in the top here at 225. And I'd make my chart bigger, but as soon as I do, it stretches out the height of the chart, and we can't see both. So bear with me a little bit on this. I'll just scroll in a little now that we're here. So again, the way the PnF measures the height, there's three different ways to count in PnF, but essentially we're counting off this last sell signal we got, and then we measure the height of this move, the one that actually broke through to a new high. So this was a sell signal because we made a new low, and then the X's came up but didn't take out the prior high, and then the O's came down, didn't take out a lower low, and then here we have this column of X's. So X's are up, O's are down. Here we have a column of X's that goes above the previous high. At this point, this was a bullish, this was a buy signal. And when we get that, what's called a double top breakout, when we get that double top breakout, this is the column that we use to measure for getting our price objective. And so rather than getting into how all of that works, I have highlighted the article here, the breakout and reversal method from our chart school article. So if you just go in there, Arthur Hill's done a great job of writing this out and all the different types of measurements you can use for point and figure. But essentially, we're taking the height of this column, multiplying it by the box size, and it measures up to 224. So the big point I want to make here is that commodities are trying to break out to a new high here, and what we should see is this PnF target up here of 224 is a target. There's nothing saying that it'll get there. But the big thing is that we have changed after being in a huge downtrend for a long period of time. We have changed to a buy signal, and the way, a major bull market. And the way we did that was when this red downtrend was broken. So just zooming back out, you can see we had this big bearish look where the market continued to make lower lows, and now we're starting, trying to make higher highs here. So here we did make a higher high. We'd obviously like to make another one here, and this gives us our buy signal. So with that buy signal, what we want to see now is that the individual commodity areas start to improve. And so with the commodities improving, one of the things, if we just go in, Goldman Sachs makes a bunch of commodity indexes, and this one is for energy. And you can clearly see we had what's called a triple top, and in this case, the fourth column. So it's a quadruple top breakout. And we've pushed up, and we have a target here. We're at 218, and we have a target of 269. So another 20 or 30% higher from here. Obviously, a nice gain would be appreciated there. So this is a pretty stellar move to the upside, and we really, based on the price action we see today, that's not a surprise that the chart is predicting higher highs. We keep making them every month. So that's good. Now here's the precious metals index. And this one is a little more complex. As you can see, we've moved sideways quite a bit. Recently, we had a quadruple top breakout and we shot up. That was here in January. We've broken the downtrend for a bear market. It's obviously been broken before. But what we've got now is a new buy signal. And it would be the height of this column that we would use to create a bullish price target. So we're trading at 1746, and our bullish price objective would be 2049. That's a pretty significant move to the upside. And so based on PnF, that's where we'd see it going. Just for everybody's knowledge, this red box and line here, because the chart is set up for a 3-box reversal, the price has to come down at least 3 boxes. And so it needs to get to 1730.00 in order to put an O in this box. And so we'd have 3 O's and we'd be on a down column. That doesn't make it a new bear market. It just means the price is pulling back and consolidating. It's pretty obvious in here that there was major resistance at 1710. So when we spent a lot of time kind of building and filling back in here. So there's a lot of support down in this area. The real question is, can we continue the push to the upside? And based on the previous breakout here, this is a pretty good signal that we're going higher. But we also had that same signal back in mid 2018 or 2017 in September. We got up here and then we rolled right back over, and we actually went on a sell signal when we took out the lower low. So again, the way the PnF chart works is when you take out a lower low, you're on a sell signal, and that would have given you a bearish target quite low. And when you are breaking out to new highs, then that's going to give you your bullish count because you're now on a buy signal. So any of the area in between is not a buy or a sell signal. You stay on the signal you were on until a new, either in this case, a lower low was taken out or a higher high. So at this point, we're on a buy signal because we broke out to new highs here. So we're on a buy signal right now, and that's why you have a bullish price objective, even though the price might pull back. And it could pull all the way down to here before it would change that price objective. Okay, so that's kind of the basics. Now let's just roll through quickly and see what's going on here. This is the agriculture sector for commodities. And again, this is a major 3-year low level here. So it's a pretty important place to watch. And in order to get a reversal, not even a buy signal, a reversal, we'd have to get above this 288. And then you can see a giant downtrend here going on for 4 or 5 years, and it keeps trying to break out, but hasn't been able to yet. 2 things. One is that if you're trying to buy near support, this is an interesting place. You can set your stop very, very close. And I think the semantic article that Aaron just talked about in the January 6th edition of Don't Ignore This Chart, I had written about semantic that was right at support. And if it doesn't hold, let it go. I think today's a good example of that. So what we see on these point and figure charts is when you're down near support, if you want to try and look for a long-term buying place. And again, commodities have a big cycle to them. And so you want to try and buy commodities low and then sell near the top of the cycle. And right now you're near the lows, and this low is held for 3 or 4 years. So we wouldn't, you wouldn't put all your eggs in this basket, but I'm just saying if you're looking for a place where you can set your stop nice and tight, this would be one. So here is, you're currently sitting right down here at a $280 or just under, and 241 is the bearish price objective. And the reason is because you continue to make lower lows. Okay. We're just going to flip on to livestock here. And this one obviously looks relatively difficult as well. We've had a big downtrend and we've broken it, but we haven't really made any progress. So since we broke it in early 2017, so this was May, since that year, we have done nothing. We've gone sideways. So while the rest of the market has continued to make big gains, this hasn't really done anything. We're trying to currently take out the previous high here, and that would get us on a buy signal. So right now the bearish price objective is 189, and as you can see, the chart down here is 204. So that would be a terrible outcome if we actually hit that price objective. But what we have here is we've got higher lows. We're on a bull market signal, and we're trying to make a higher high on this column right here. So if we got above 292, 292.00, we'd put an X in this column, and that would change this number from a bearish price objective to a bullish one. And the reason is because we're now making higher highs again. So agriculture in general still looks messy. I would say that the grain side of it is trying to hold at this support level. Livestock's really spent a lot of time in the last 3 years right around this level. And in order to get a meaningful breakout, this would be nice, but really we kind of got to get above this cloud here that's been going on for 2 years. But it is bullish to at least see that we've been breaking this downtrend, and that's gone on for almost a year now. Okay, for the industrial metals, this is up and away, big bull market. And again, when you see these downtrends and you start to switch over to a buy signal, this is a pretty important area you get through. We spent some time consolidating last year here. There's a December and a January in there. So here's December, January, February, March, April. We spent a lot of time, and then all of a sudden we broke out meaningfully. And when we did that, jumped right up here. So this was 316. We're now at 392. Price objective is 467 for industrial metals. That would be steel, copper, zinc, that type of stuff. So not very fancy stuff, but you can make some money in it when you get a nice uptrend like that. And some of those stocks have been on fire for the first month of the year here. This is the total commodity return index. And in general, it's saying 3,000 for a price objective, and we're at 2,600. So another 10% higher here just for overall commodities. This is the chart for Brent crude oil. So West Texas is the crude oil really for North America that we all base our price on. Brent is the world price. And what we see there is this is at $69.45. We made it to $70, I think it was early last week. And now, obviously, this long pole here, it wouldn't be a surprise to build the flag formation where we took a little time to kind of consolidate the gains, I think is the right phrase for it. But clearly, this was the basing level. We broke out to a new high. I am not bearish on oil at all. You might get some pullback, but I think it's pretty important to be aware that there's a major base that was built, and we've now broken out of that base. Here's West Texas, again, North America's crude oil measurement. And so we broke out to higher highs here. We had a brief little pullback, went on to higher highs again. This one represents January. And so we were up to $64 and change. We have to get to 65.00 in order to put the box in here. So 64.99 doesn't get it done. And it would stay in this box all the way to 65.99. So these boxes are $1 range, but the important thing is that this is a big bull trend higher. And I think after the original breakout, it's not usually a good place to start trying to short things. Big commodity markets can continue to head higher. So this move off the 2016 low, we kind of built some flag patterns here, broke out to the upside, flag pattern, broke down hard actually into the middle of the year with some lower lows, and then we started to make some higher highs. But in general, I think just stepping back, looking at the chart, we had the big downtrend from 2014, 15, 16. We broke through that into an uptrend, briefly had a corrective period, and now we're on a bull market run. So I'm very bullish on the energy area. This is XOP, which is the Exploration and Production Group. And what we see here is these charts are trying to break out to the upside. So we've broken the downtrend again. It's nice to see, but we still have this whole consolidation area here that, starting to get above that into higher ground would be very bullish, and we'd like to do that. We're at 39.20 right now. We have broken the downtrend, so we've actually got this blue line showing up here saying we're back in a bull market mode. But quite frankly, getting through this horizontal resistance is a pretty important area, and a push above 40 and 41 would really help consolidate the image there. Oil and gas equipment services, this is a really exciting area. And the reason is, again, tested major support back in 2017, started to make higher highs. We've broken the downtrend. We're on a bull market signal. We're currently trading at 1865, and it suggests a price of $23. That's almost 20 to 30% improvement just to get up there to 2016 highs. So keep that in mind. I think there's lots of opportunity here in the oil services. If natural gas would participate, we'd have a little bit more fun. So just scrolling up to the natural gas chart here, what you see is we just tested, we had a big low in 2015, and we tried to rally up. We're unable to make new highs yet. So this chart is very, this goes back to 2005. The chart sensitivity could be changed. But the big issue here is we really need to get through this 350 area, and we're sitting down around 325. But we need to break this downtrend in price and trying to get it to go to the upside. And one of the major changes in both natural gas and oil is natural gas was hard to ship worldwide. So you needed things called LNG terminals, which compress the gas to a liquid, put it on a ship, keep it very, very cold, move it across the ocean. On the other end, you need something to take it out of that very cold situation and let it warm up slowly, and then put it in pipelines to distribute it properly. So LNG is becoming much more popular. The price in North America is around $3. Prices around the world are way higher than that, like double and triple. So there's a lot of nat gas that wants to leave, and if it can access foreign markets, it'll bring the price up substantially. So with both Brent and natural gas trading higher elsewhere in the world, so oil and gas trading higher in the world, it does put an upward pressure on that for us. So we'd like to see natural gas really start to join that party. But right now it's at a very important area on the chart at 320. Here's coal. And the point I want to make is, there's been a lot of discussion about dirty coal or whatever, but China's still got another 50 plants coming online. I think India's got a whole bunch as well. So all of these coal plants coming on, this chart has just started to move. We've just broken through the downtrend here. So as soon as we break through this line, the software automatically adds this blue line, and we can see that this coal chart looks really robust here. It's currently trading at $17. It's got a price target of $27. Let's just say it gets there in a year. I mean, that's a 50% gain. So at least maybe even 60 or 70, $10 on 17. So 60% move. Here's copper. Copper recently broke out, and this is just a big bullish signal here. We're starting to see Shanghai and the Hang Seng markets do really well. India's stock market is on fire. So all of those big high demand areas. So China's 1.3 billion, India's 1.3 billion. That makes up a third of the world's population right between those two countries. Their stock markets are starting to rock. So this is a very bullish situation. Maybe copper needs to consolidate. It's overbought like everything else in the market, but still, this is very bullish. We're on a new uptrend, and you can see this is 2012, 2013, 2017, and we still haven't made a new buy signal in 2018, so that's why you don't see a one column here. If this actually got below $3, so 3.00, we'd actually go on a column of O's. That wouldn't necessarily be scary. I would suggest support is right in this area here around the 290 level, and we'd probably look to bounce up and out of there. But copper quite clearly has broken into a new bull market from a 5-year bear market, and not a place to avoid. All of the major miners like BHP, Vale, Rio Tinto, Freeport-McMoRan, and Teck Resources have all started to break out in a big way. And I think there's lots more to come in 2018 for those stocks. Here's the copper miners index and the ETF, and it's obviously higher highs and higher lows. We broke out of this base back in, this was December of 2016, and November, and then we've rocketed back up here, and here was our most recent signal. So this is just up and away. Definitely on a new bull market there. Here is gold, and Tom and I and Aaron always get to debate gold a lot. Arthur Hill looks at it every morning. It's pretty important. But what we see here is there's a major horizontal support and resistance layer in gold right in around this 1310 level. Recently, we've just broke above it. We've got a new buy signal on gold with this push above the red line. And the target is for 1549 for the price, and we're at 1339, so $200 from here. Obviously, as a commodity guy, I'd love to see that. GDX, this is the gold miners, and what we see here is we're in a big bull market. Let's not make any mistake about it. Rising lows held here, lows held here. We're trying to get on a new bull market signal. So we need to get through this $25 level. $26 would be great. We have a bullish price objective here of 33 currently. It's at 24 now. So you can imagine a 50% gain would feel pretty good in your portfolio. The move off the 2016 lows to the August highs was 150%. So this is very volatile stuff. But again, there's a lot of support right in here at 21, 22. When you can look horizontally on the chart and see lows there and highs in that area, you're at a major support and resistance level, much like we'd see on Tom and Aaron's candlestick charts. So this is a critical area. We're currently sitting at around $23. We would say there's high level of support here at 22, 21. And this upward sloping line here would also suggest a place to bounce from. So these PnF lines, they don't change angles ever. They go at 45-degree angles. And so you'll always see them just kind of cut down the page, and wherever they break, this break here causes the blue line to be added right back to the last major low. So, these are on bull market signals. So the industrial metals, the precious metals, oil, all of that stuff is really rocking, and we want to see more of that. Here's silver, and on the silver chart, you can see we keep trying to break out of this red bear market downtrend, and we haven't been able to do so. In 2017, we came down and tested the major lows, and one of the important concepts in commodities, again, is that they really range trade. And so when you can get something close to the lows, it's a good place to look when you can set your stop closely, because usually things that actually have to be mined, like not internet stuff that, user numbers could change quickly. There's a physical cost to mining stuff. You need it to make stuff. And when those two things combine, a physical low price and an oversold market or whatever, they can be very volatile and moves from 1450 to 1750. This would be a 20% sort of move that we had. Well, now we're still consolidating that move. We're at 1760. Huge resistance layer at 1850. If we could get through that, I think really we'd probably see a massive pop in silver, much like we saw in most of the other ones, where it would funnel quite a bit higher. But we still have a bearish price objective of 1550, and in this case it says met. So we've already been down there making that bearish price objective, and we haven't started making higher highs to cancel it, but it doesn't continue to make lower ones. So here's silver miners, again, trying to hold in. We're currently at 33 here. We're trying to hold this support level of $30. Price objective is 27. you could see looking on this chart here that there's a lot of support in this area. So you don't want to get too bearish on this, but basically since the early moves in 2016, this $30 to $31 level looks like major support. We're at 33. So we're on a bearish price target, and the reason is because we can't make higher highs yet. And until we can do that in the silver miners, it's still a bear market. But again, we're very close to a major support level, so keep that in mind. Corn, this chart's just ugly and gets uglier. This is a huge pullback here, and we keep making lower lows. Support is quite a bit lower. The price target is 324, and we're currently at 350, so another 15% lower for the price target. I'm not quite that bearish. If we could actually pop through and get through this 364, I think there's opportunity. But one of the big changes for corn was in the big bull market back over here, corn was trading a lot higher, and that was because they were using it for ethanol. With the low price of crude oil now, ethanol really isn't as viable or as cost alternative viable as we'd like it. So there's a lot of saturation for feed corn compared to using it for energy. Okay, the tin market is oversold here. I'm not going to spend any time on it because it's so thinly traded, but bearish price target of 36. It's at 46. That's a 30% hammer. Probably don't want to party in that one. Nickel has a lot of benefits going forward. It's another big industrial. We might think of it as currency for our nickel, but the other side of it is this is $15, price target 22. That is a huge move. That would be 50%. So really nice opportunities there. Corn, already covered that one. Let me get to the grain indexes here. Does that look like a bear market? I think so. We're in a big red downtrend, and we've got horizontal price support in around $29. So we're trading at 30. So the one thing is you're at a long-term low. If you want to use that to trade against, that's not a bad idea. But again, if it keeps breaking down, this is a party you don't want to stay at. And lastly is our chart of wheat. And what we see here is wheat has a major low set up here. It continues to try and hold this. This goes back years and years and years. But the big thing is we're sitting right near support. So if there was a reason to get involved in agriculture, it's because they're all beaten up and down near support. But again, if you don't trade with a stop, this is not a party you want to play at. So. And with that, that's kind of my wrap up for PnF. There was one question on the chart for the Toronto Stock Exchange, and it basically shows a much higher price target, almost 1,000 points higher for the TSX. And that's probably a good indication of where I see commodities going over the next year. We should have a pretty good year there. So in review of point and figure, you're going to have the big picture for commodities, the CRB index. We look at least 10% higher on that right away here. Not right away, but breaking through this 196 level would get us to 225. Energy is very robust here. We're expecting a 20 to 25% upside, and that would not surprise me with both crude oil now being able to ship out of the US and nat gas. So with all of that, I think there's big opportunities in the commodities, and I would look to precious metals as a good one. And again, if you wanted to play support, agriculture and livestock are way down there, but you need to have a stop underneath it, because if those markets really do come apart, it would be a painful hold. And lastly, industrial metals, I think, is very bullish, with the top 5 miners in the world all breaking out to new highs recently. So with that, I'll wrap it up, and thanks for the opportunity.
All right. We certainly appreciate having you on today, Greg. I know you don't have a whole lot of time today, and we're going to move on to the next segment, but there were some questions in here, so we'd love to have you back maybe and go over some of these questions maybe on a future visit.
Sure.
All right. Sounds good. Appreciate it so much for you coming in today, and we look forward to your next visit.
Thank you.
And enjoy the weather out there in Scottsdale, by the way.
Okay. Thanks, everybody. Bye-bye.
I'll see you. All right. There he goes. Greg Schnell, of course, senior technical analyst here at Stock Charts. Always great to have Greg on the show. He's got so much great insight, especially in the commodity area. And he went through a lot of charts in a fairly short period of time. So again, thanks for putting that together for us. We do have a couple of minutes here. Let's get into the momentum sleepers. I'm going to go ahead and just share one particular area maybe to take a look at that I think is worth taking a look at. And so I don't think I'm going to catch anybody by surprise. It was kind of sleeping for a while, but it actually is starting to pick back up again with a big breakout yesterday. And that area is the semiconductors. So on the semiconductors, you can see this huge move to the upside. But this was where it kind of went to sleep for a little while. Everyone kind of forgot about it because the market kept going higher and the semiconductors really were not participating. But I think that's all changed. We've now gotten a breakout here. And the stock in this space that really has my attention at this point is AMD. AMD, from a short-term perspective, looking at the daily chart, you might look at this and just say, wow, this looks like a big mess. But off of this downtrend, you can see a left side of a neckline, then a head, right side of a neckline. Looks to me like today we might be getting a breakout. Volume is beginning to pick up. And I think what's interesting really is when you look at the longer-term weekly chart on AMD, after a huge move to the upside, we've just simply been consolidating. We've had trouble up around the $15, $15.16 range on the upside. But to the downside, we've had really good support around $9.50, $10. And that's where we're bouncing from now. So sometimes the daily chart looks a little muddled, but that weekly chart can kind of clear things up. And I'm beginning to see some real strength here in AMD, and it's within a very bullish breakout of the semis. So that would be my pick. What do you got for this area, Aaron?
All right. Well, I went ahead and I ran one of my scans just to, of course, narrow the field down as far as momentum sleepers. And what I did very quickly is I basically just looked for 5-day EMA positive crossovers of the 20-day EMA. And of course, my regular screening process for what my universe is. And then I wanted to make sure that the 20 was above the 50-day EMA, just so that, the momentum was starting to turn the right direction. I ran the scan and I ended up with, about 23 stocks. So I went through and, cleaned them up. I don't have 23 to show you, but I was just going to briefly show you a few of these. One of the things I looked for were rising PMO bottoms. We're seeing a scoop here, and there's that 5-20-day EMA crossover. I think there's, easily room for it to grow up to the, at least $29.50, $30. So not a bad possibility, but you can see the momentum is starting to shift and prices have bounced off now of that 50. The next one I have for us is Greenbrier, GBX. And same thing, there's your 5-20-day positive crossover. And we've got the PMO. It is rather flat. So I don't know if I'd make this one of my picks, but you can see we hit this area of overhead resistance. And now we're trying to hold on to that 20. So could be a sleeper here. HMM, Horace Mann Educators. This one looks like we might be getting somewhat of a ascending triangle. If anything, we're in a trading range. And now we're finally seeing that 5-20-day EMA positive crossover. It failed over here. And we are holding the 50. And look at the PMO. It's scooping up right above the zero line. So, pretty interesting chart there. Mohawk, MHK. And this one hasn't quite broken out above this area of overhead resistance. But again, we've recaptured that 20-day EMA. We've had that 5-20-day positive crossover. And I am starting to see the PMO turning up. And we have this second bottom would be above this previous bottom from back here. So I liked that one. And I think this was my last one, United Natural Foods, UNFI. And you can see this really nice move. I would look at this as an ascending triangle sort of pattern back here. And we've broken out above that. We're holding above the 20, got that 5-20-day EMA crossover. And you can see while the PMO is flat, it has decelerated. And we're looking at a bottom higher than the previous two. So I thought that one looked pretty interesting as far as momentum sleepers. VeriSign, same sort of picture here. We've got some room to grow here to get up to that overhead resistance level. And again, nice PMO. Granted, your PMO bottoms are falling lower as prices are rising higher. So, you could consider that as far as a possible problem. But those were the ones that I had for momentum sleepers. And at this point, Here's the ones that we looked at, and those are the various symbols that we discussed. And so you'll be able to go back in the recording and watch it later if you want. But with that, I know we need to move into the 10 and 10. We're starting slightly late, but I think we can handle this.
No problem.
Yes, the first one was Beazer Homes, BZH. And I think you talk about this one occasionally.
Yeah, and also there was a couple comments in the room about AMD reporting earnings coming up the end of this month. Just keep in mind, not only for AMD, but for all stocks, I mean, we are really hitting into the heart of earnings season. So the next couple of weeks, we're going to see literally thousands of companies coming out with their earnings. I would say maybe over the next 3 weeks, there are thousands of companies. So just keep that in mind with any positions that you enter. I don't like holding through earnings reports. Beazer Homes, let's see. Well, first thing I would say is that was a pretty significant top here. Very heavy volume. Look at that big red candle. So first thing that this would tell me is that that's going to be a major resistance level. So I'm going to draw my trend line or my horizontal price support resistance line right there, because that's going to be a target for me on any potential trade. I think the recent lows coming in right at about 1875 provided some support. Got a little bit of overhead resistance from the past couple of weeks trying to get through 2075 or so. We're sitting in the middle of this longer term range. So the problem is, if I get in here, in order for it to make sense from a trading perspective, I'd probably have to use the rising 20-day moving average as a stop if it closed below it, because otherwise, if I give it all the way down here to price support and I use this, the high from November as resistance and my target, it's really 1-to-1 reward to risk. And that to me is just not that exciting. So I'd have to find a tighter stop. For me, given what's going on in home construction, the huge run up, the miss this morning on housing starts, I probably would avoid this one. I don't really see a great trade here. So I'm just kind of neutral on Beazer at this point.
All right. Number 2 is going to be JEC, and that's Jacobs Engineering Group.
Yeah, I was actually looking at this one earlier. I think this is a really nice looking chart. Continues to move higher. I would say, if anything, maybe there's a little bit of an issue with a divergence in the short term. But even with that divergence, take a look at the volume, because keep in mind, the MACD does not take into account volume. So all it's telling you is that when you're going higher here with higher prices, with the MACD being lower, it's saying that there perhaps is a little bit of an issue with slowing price momentum. But check out the volume on this move to the upside. This is not light volume. To me, this is accumulation. So I ignore the negative divergence in this case, at least as long as I continue to hold the rising 20-day moving average. So I think for this one, for me, really the thing that I'm going to watch closest is just this rising 20-day moving average. It's been holding as support. Really, you go back all the way to the August low. Once we broke above, we only had maybe this one little period, and I think that was right before earnings where we broke below the 20-day. Otherwise, we're continuing to trade above it. So I think this is a really nice looking stock.
All righty. Next one I have for you is Agilent.
All right, Agilent. Another nice breakout recently. Got pretty good volume on the breakout, better than average, I would say. But this is where the resistance level is marked. We had a couple of different tops here. You can see the big red candle here coming down, continuing weakness. There was the prior low. So that was the trading range for a while. Made a move. We finally made the breakout. You can see there's the heavy volume. Now, the next day was even heavier volume to the downside, but we did not lose the price support level. So we've currently got price support at about 70.30, and you've got the rising 20-day underneath at 69 and change. So for me, again, if I'm annotating this, just as a reminder, I'm going to be watching that 20-day moving average and price support. We currently sit a couple dollars above both.
Okay. Next one for our Canadian friends, JE.TO.
All right, Just Energy Group. Well, considering what Energy's been doing, and I'm not familiar with the company, but just based on the name, I'm a little surprised that the stock has done so poorly, given what Energy's been doing. But again, I don't know exactly what the company does. It could be technology in the energy space. I mean, who knows? But the downtrend bothers me at this point. So I think what I would be doing is maybe following the trend line and waiting for perhaps a break to the upside. So maybe something along those lines is what I would be watching, keeping in mind that current support is going to be that recent low. So right there. And so I think we're squeezing in this range between about $5 and $5.30. If it does get through this $5.30 level, to confirm, I'd want to see accelerating volume.
All right. See, next one I have for you, number 5 is APC. Petroleum.
Or no, Anadarko. I'm sorry, Apache's APA. Okay. Well, it's in the energy space, which has been very bullish. Greg touched on that a little bit earlier. I would just say as long as the trend continues, you want to follow it. So you've got breakout after breakout. You can see here was the breakout. Here was a prior breakout or prior top from back earlier in 2017. We made the big breakout on heavy volume. Notice these pullbacks essentially holding that support around 47. We finally made the breakout above 52. So we do have an open test possible down to 52, but that would probably coincide with maybe a negative divergence somewhere down the road as we keep making higher highs. You can see the MACD continues to strengthen as well. Solid volume on this move to the upside. I don't see anything negative here. So again, for me, as long as the stock continued trading above that 20-day moving average, I'm good with it.
Okay. Let's see, next one we have is STMP, stamps.com, I believe that was.
Yeah, STMP. I think this was earnings related back here in November with the big gap down, and it did break into this gap resistance zone, and it just kind of lost its move to the upside. I think right now it's squeezing in a range. So I think what I would be doing, there was that resistance level I was talking about, and you can see how we broke above, but then we came right back down below. I didn't like that. But now we have the high close at around 200 that we need to break above. And to the downside, if you're considering this the latest 6 weeks to be an uptrend, then you really want to see the rising 20-day continue to hold. You can see how it's been pretty solid for the most part here. As long as that continues to hold, we've got a golden cross where the 20 went above the 50. MACD is back above the center line. So I'm okay treating this as an uptrend, especially given the fact we're in a nice bull market. But we really should break above 200 before we go back down and close below, say, 186, 187 or so. So I'd use that as the trading range currently, and I'd be looking for volume to pick up again on this move above 200.
All right. Next one is the Aerospace and Defense ETF, XAR.
All right. This is one of the best long-term areas of the market. Aerospace and defense seem to go up no matter what the market. Probably a good piece or a good area of the market to be in if you have a long-term portfolio, because they do tend to go up in almost any market. Short term, we're getting overbought. We did have a reversing candle recently, so maybe in the short term, there's just a little bit of a concern, although it didn't really hold back the overall market the other day. But anytime I see that and I see the volume pick up, it just tells me maybe we've just gone a little bit too far off this uptrend. We need some sideways consolidation, maybe even a little bit of selling. And I think if this ETF were to pull back into the 84, 85 range, that's where I'd be most interested. Because again, you can see we got a nice uptrend going. MACD looks good. So normally pullbacks to around that 20-day moving average are strong. If we dipped a little bit below, then you have price support at 84. So 84, 85 is what I'd look for to the downside.
All right. Let's see, the next one is WGO, Winnebago.
All right, WGO. Negative divergence is the first thing that stands out. And really, this always bothers me a little bit when you get a key resistance area and you continue to struggle. You can see how we got up here back in mid-December, right about 58, came back up again later in December. Of course, that was during the holidays, but couldn't get through. And then just a couple of days ago, we probably can even draw this just a little bit lower, but just a couple of days ago, literally came back up and hit 58 again. But look at what the MACD was doing during this whole process. Couldn't get through. MACD rolls over, and then we have the failure. Now we're getting that 50-day test, and we're getting a MACD centerline test. The key area for me is gap support. So I'm going to go right back to here. This is where we had gapped up, and you could even say a reaction low off of that gap. So I'm going to say 50.5 to 52 is an area where I would expect to see WGO turn back up. This could almost be like a momentum sleeper kind of a trade where the stock in a straight uptrend, but it just got a little bit overdone for a while. MACD gave us some warning signs. We're consolidating, moving a little bit lower. Look for the 50 to 52 area for a reversing candle.
All right. Let's see number 9, KHC, Kraft Heinz.
All right, Kraft Heinz. Been in a downtrend, and of course, this is going to be a little bit more of a staple kind of a stock. So, not the best kind of stock for me anyway. I'm looking to outperform the market, so I want to be in areas that are outperforming the S&P 500. And I don't think the overall area that Kraft Heinz is in has been a great performing area. And you've got a stock here that clearly has not been performing well. We've had a raging bull market, and here Kraft Heinz sits at 79. 6 months ago, the stock was at 86. So it's down almost 10% while the market's been going higher and higher. So I'd have to see maybe a breakout. We do have the potential for a bottoming head and shoulder pattern. Looks to me like we got a neckline coming across right here, left shoulder, neckline, head, neckline, much deeper right shoulder. But look at the volume starting to come in here on the right side. A breakout above about 82.25 with heavy volume would at least indicate to me that maybe a KHC could at least begin to perform along with the S&P 500, if not outperform it. But until we get above that level, that neckline, I'd be careful with it. You have the last one, Aaron?
I do indeed. The last one is going to be FCAU.
In the automobile space. Fiat Chrysler. Big breakout here to begin the year. Huge move up. Just got overbought. I mean, for me, the big level, if it can pull back, I think there's going to be a couple of areas. Well, actually, a few areas. You got price resistance right in here at about 18.5. We took that out in early January. Also, now we have a major gap up here. So we're going to have some gap support between 19 and 20. You've got the rising 20-day moving average at 21. I wouldn't want to chase it because I don't want to take the risk of having it come back down and test one or maybe a couple of these support levels. But for me, the first entry would probably be on that rising 20-day moving average, which is currently sitting around 21.
All right. And that concludes the 10 and 10. You can see which symbols we went over. Somebody asked where you can find these charts. They're in the Market Watchers Live chart list. I will put them in there in a couple of hours so you can find them there. And with that, I think we do need to move on to our final market update. And let's get started. I'm going to start off with our candle glance screen, of course. And what we can see are the markets. Yes, they have been trailing downward. We're still not really breaking that overhead resistance, that declining tops trend line. So I wouldn't be looking for much more of a recovery at this point. NASDAQ's doing all right, down, but down slightly and compared to our other indexes. Small caps are trying to make a move back up after setting intraday lows around 1577.50 for the Russell 2000. We can see Treasury yields are up and moving sideways, currently at 26.05. UUP has formed a double bottom here below yesterday's close. Looks like it might be heading toward positive territory if we can break over that neckline. You can see commodities formed a nice flag after a difficult morning. Still in the negative right now, mostly unchanged for DBC. USO, however, has made it into the positive and is currently at 1281. GLD is mostly unchanged at this point, moving sideways, and we can see the VIX is above 12 right now, which, as Tom was mentioning at the beginning of the program, is considered high right now because we haven't seen that many readings above the 12.5 to 13 level. So interesting to see that. We're going to move over to our market summary so I can give you a look at which sectors and industries are doing the best. And currently we can see technology and materials are leading as far as the sector spiders. Consumer discretionary up slightly. The rest of the sector spiders are all in decline currently, with utilities being the biggest loser at this point, with down over 0.8%. Could see you as far as U.S. industries, paper and transports, semis just moved up into the top 3. And for our laggards, REITs, utilities, and broker dealers. Definitely seeing utilities as the laggard almost every day, it seems like, Tom. And we can see as far as our international ETFs, Russia, Taiwan are leading the list. And as far as laggards are concerned, South Korea and Hong Kong, as well as Japan, are all in the bottom 3. I'm going to take us now over to our homepage and take a peek at our scooter movers currently. So right here, this is our top 10 currently sitting up there. A lot of consumer discretionary cyclicals up here. We're going to see which are the biggest movers right now, though. And we can see that AES Corp, nice breakout on a gap up. And I believe that's Wyndham. Yes, you can see that another gap up, breakout above overhead resistance, looking pretty interesting. I'm going to go ahead and just pick this one up. And there you go. Really nice breakout above overhead resistance. I think at this point, what I'd be looking toward is a weekly chart to get some idea as to possibly upside targets. And at this point, it's making all-time highs. We did just get a PMO buy signal on the weekly chart. However, the PMO is rather flat, which would worry me about the continuation of this particular rally. And with that, I'm going to close out the market update. But did you have any comments you wanted to share?
Yeah, I just wanted to go over real quick. Looked to me like the autos, which are struggling. We were just talking a minute ago about fiat, but the autos in general have pulled back. So I wanted to show that chart and a quick look at Tesla as well. But here's the automobile index. You can see the big move up here in January, broke out above these prior highs. And it's pretty significant, I think, when we look at a longer term chart on the automobiles. This is just going back the last 3 years, but I could even stretch this out, maybe take a look a little bit longer, go back throughout most of this bull market run. But you can see that back in 2013, 2014, we got up to about the 230 level. And then just recently in October, we went up to about 235. And now this year, we have now touched 240. So it looks like the group is trying to make a breakout. And then when you go back and look at the daily chart, you know, we're getting really good action on the long-term chart, breaking out above multi-year consolidation. And the daily chart on the move up here, you can see the MACD looks strong. And we're just testing this rising 20-day moving average on the DJUSAL AU. So if you take that and then take a look at the chart on Tesla, Tesla is actually trying to make a breakout today above some recent highs. So when you look back over the last 3 months or so, this is a 3-month high, and the volume's been picking up again on Tesla as it's been making this push to the upside. So given the fact that the autos are down at a key support level, and I would expect them to bounce, and the fact that we're getting a little bit of a breakout here in Tesla tells me that we're seeing some relative strength right now in Tesla. And I would not be surprised to see some additional strength as we close out January this month. Maybe initially make a push up toward the October high, which is about 360. But ultimately, I think we're going to go back up and test that 385, 390 level that we saw back in September. So with that, we will close out the market update and move into anatomy of a trade. Would you like to go first or would you like to go second?
I will go first this time around. Let me go ahead and share my screen. I'm going to only go through one because I annotate my charts to death here. So I'm going to talk a bit about this. So this was actually my Monday setup pick, but I was looking at this chart and I thought it was a great learning experience as far as how I would have gone through this trade. This is a paper trade. Was not an actual, I'm an intermediate term trader, and I just don't trade nearly as much as Tom does, but I'm happy to share my strategy of stock picks for the intermediate term. So I started over here. This is when I bought it, basically right after we got that turn in the PMO in oversold territory, and the buy signal came in or right before the buy signal came in. So I bought it at 21.50 as far as this paper trade. Okay, as soon as I buy it, or even actually before I buy it, I want to set my target, and then I'm going to set my stop. So for me, I look as far as targets toward overhead resistance. And in this case, I felt that the target would be about 24.50 based on this top for the overhead resistance. Okay, so as we travel through this trade, I get that intermediate term trend model buy signal. I'm feeling pretty good. 20 is holding and we're taking off and things are looking pretty good. I reach my target. The stop, by the way, I'm sorry, I didn't tell you, is set at this previous low back in April, which was at about $20.50. All right, so I've set that stop. I've now reached the target. And to me, once I hit the target, it's time for me to reevaluate the trade, reset my stops, reset my targets. And at that point, maybe even sell half, take some of those profits and then continue on. In this case, I'm going to run through what I would have done at that point. So I would have seen the breakout. I would have seen the PMO rising. I'd have probably seen a little deceleration, but as I tell people, I don't trade. I don't get out of stocks based on the PMO. I use the PMO mostly to get in. I find it to be interesting information and helpful in whether I stay in or stay out. It's very helpful when I hit these reevaluation periods. So I've broken out and I'm coming back down. This is my new area of support. However, I would set my stop below that, probably around these highs, right about here. That would take you down to about the 50-day EMA if I wanted to stick it out that long. But again, it's an intermediate term trade. I always come into that reevaluation period. If I start seeing, for example, this was rounding off, I probably would have looked at it. I would look at it mostly every day anyway. But so anyhow, then I have my new target, right? So I have my new stop down here. I've made it through here. So where the heck am I going to set my target? Well, at this point, of course, I didn't have all this information. So I would go to the weekly or the monthly chart is what I ended up going to. I'm not going to show you that, but based on overhead resistance on that monthly chart, I set my target at 29.50. So I've moved here. I've broken out. And yes, that's a very tall target, but that was the place of the next area of overhead resistance on the monthly chart. So heck, I'm going to set it up there, see if we can't get up to that resistance level. I'd be staying in. This would have been at the $27 range. I would have been extremely happy, but there's nothing that would have changed my mind. So I would continue upward. And I would hit that target, right? 29.50. And as I said, reevaluation time. So again, I took a look at the monthly chart, decided my new target would be about $31.80. And my new stop would now be down here because I have this information. So I would have set my stop right about this area of support, overhead resistance. I'd already done pretty well on this, again, paper trade. So I can set my stop pretty low because at that point I've already hit some targets. I'm already doing pretty well. All right, so we hit the top and we start back down. And, I would have held on because what are we seeing over here? I would have held on even though I'd have lost this area here. And I think this was set. Okay, yeah, that was my second target. So I'd have hit my target, would come back up, and then I would have evaluated. We now see that price is moving downward. I would be looking at what's going on here, and I would have seen the sell signal, but the 20 was holding up. But as soon as the 20-day, was lost as far as support, I'd have bailed. I'd have taken my money at the 5 and crossed below the 20. I had the PMO sell signal. There's a lot of information here that told me, you know what? Take some profit. So I didn't make my target and actually fell below what my second target was. But I held on, and I would have held on. Now we're talking about 3-4 months. And so I would have probably sold at that point on the loss of the 20-day EMA, which would have been about 28.50, which is a gain a pretty nice gain. So that's sort of going through the run through. At this point, I did pick this as my Monday setup because we were just at that PMO buy signal coming in here. And so again, my target for this one would be up here at that overhead resistance. And I would probably set my stop just below $28. The 20-day EMA would help me determine that. So, and now we do have the PMO rising, and I've made this my pick. So, double bottom, if we get the breakout above that neckline, I mean, that looks pretty good. Yep. So that would be mine.
Okay. All right. Let's see. Well, I have slowed down my trading a little bit recently, but yeah, I do trade a lot in the short term. And I normally trade off my strong earnings chart list, which has a lot of companies that have beaten top line and bottom line Wall Street estimates, and also look good, or at least in my opinion, look good technically. And so I wait for those stocks to come down and hit key support levels. And many of these stocks, by the way, I do provide Monday setups at the beginning of the week. So you can find a number of these, such as NOMD. This was actually a setup that I provided this week. You can kind of see this after gapping up with earnings at the end of November, heading into early December. Really nice move to the upside, breaking out above all this consolidation, and really the two key levels of support on a stock once it prints a candle like this, in my opinion, is the close right here. So you gapped up, you were trading up to 1690, but it did come back down and close around 1630, and then the intraday low was around $16. So this is a support level. Here was a really nice hammer that came in, and I didn't get it at the low. Unfortunately, I did get it at the end of the day, that day at around 1630-ish. But you can see the stock has bounced off of it. It's trying to make a breakout. I'm already out of the stock. If it makes a breakout, that would be great. But all I wanted to do was to see it get back up to price resistance, which it has done yesterday and today, up around $17. Now, it may simply come right back down to the support level, or we might get the breakout. Like I said, there's very heavy volume on it today, so a breakout would be confirmed by the volume. But that is one trade that I recently made this week. And let's see, let's go over CLDR. This is Cloudera. CLDR, another one that made a really nice breakout. Let me annotate so you can kind of see these levels. But after the gap up, here was the earnings gap up. So we had been in a downtrend. To me, this is a breakaway gap. I would mark support at the bottom of this level. And I normally don't put these stocks on my strong earnings chart list until after they've gapped up with earnings, and then I see the action for the could be next couple of days, could be the next couple of weeks. But in this case, we gapped up, we went all the way back down, filled the gap, and then went right back up near the top. So this is kind of a trading range, if you will, in the very near term, the bottom of gap support, and maybe up here near the top around 1750. But the candle that got me in actually was as it was consolidating. I like the MACD here starting to come back up again. And if you look at the hammer, I run a scan around 345 every day. And I run a hammer scan against my chart list. And right there was the hammer scan where we went, the hammer that printed, where it went back down below the 20-day moving average, came back up above, and I think the stock got an upgrade. So definitely was fortunate on this particular trade. Now, unfortunately, after marking a top and coming back down, I held, but I actually had a sell order in today at 1830 or 1835, which got executed. So if it breaks out, it's probably, could be heading up here. Could be heading up here for that retest of the September high. But again, I'm fairly short-term in nature. Sometimes they make the breakout, they keep going without you. And if they do, that's fine. I got my objective out of the stock and exited. Now I'm going to show you one that I just currently made today. And it was actually one that I sold recently. I talked about this last week. Literally, I was going off the air, and the stock was right near major resistance level. And this one, I actually took the profit, and it turned out to be a good move because the stock came back down and gave me a chance to get out again. But it was right here. It was trying to get through about $9.45. And look at the volume coming in on this move. And I remember signing off, or when we were doing the anatomy of a trade, and I said, I'm just going to kind of watch and make a decision later that day to see what the heck to do. And the volume is what got me. If it had been light volume, I would have said, no doubt, I'm taking the money and running. But the heavy volume came in pretty early in the day, but it never made that breakout. By the end of the day, I said, all right, that was a nice gain. And by the way, that one also, I think that was over here somewhere where I had gotten in, maybe around 850 or 860. That was about a 10% move in a fairly short period of time. And I was at price resistance, and that's my style. I try to get in toward the bottom of support so that if it breaks, I can then get out fairly, with a fairly tight stop. But if it moves to the upside, it gives me a nice reward. The reward to risk is what I'm most concerned about as a trader. I want to make sure that I'm not taking too big a risk. I mean, anytime you hold a stock overnight, you're taking a risk. The stock could come out with a warning. But again, using my strong earnings chart list, I kind of feel a little bit protected from that type of news. Maybe I shouldn't, but I just feel like if a company's reporting stronger than expected earnings and revenues, that they probably won't come out with a warning. And for the most part, that is held true. But I'm actually back in to SPWR. I actually had an order in for 840, and it's sitting at 846 right now. But if you look at the recent lows, which down at around 840 and change, and then I think gap support was 834. And I think the earlier low got down to 836. Today actually did get down to 830, so maybe I could have gotten a little cheaper. But this is the range that I'm trying to follow on the stock, between about 835, 840 to the downside, and 950 to the upside. And so if I can buy at the low end of the range, sell at the top end of the range, I'm going to be pretty happy. So that is one actually I just got back into today. And I know someone was asking me the other day about FINL. I'm still holding FINL, but I'll pull that one up. I have sold out of a lot of positions. I'm probably 50% cash or more right now.
Mm-hmm.
But here was the move up on FINL. It came back down. I actually got in twice in here. I got in once. I think it was around 13 and a quarter. And then the second time was down here when it went, I think, a little bit below that 20-day moving average. And I was using a stop closer to 1250 on that tail on a closing basis. Intraday, if it were to break down and the volume were picking up, I'd have to make a decision. But the goal is for me to hold on as long as that tail from earnings holds as a low. And so right now it's just kind of consolidating. What I'm hoping is that off of this uptrend, this turns into be maybe something like a cup. We could maybe see maybe one more movement lower. So I'll just annotate one more thing before we wrap up. But one thing to maybe anticipate or to expect is maybe we would see something like a wedge. So you can see these tops coming down, and then maybe even from over here, kind of something like that. So maybe we come back down one more time into the 1260, 1270 area. But what I eventually want to see is a volume pickup and a breakout back to the upside and above this trend line, and make another move back toward 15, which is my target. And that is basically what I have for today for Anatomy of a Trade. So
All right.
here is a summary of some of the stocks that we looked at today. And I don't know, we got a couple more minutes left. What do you think about the market, the action?
You were just saying how you've pulled your exposure back with some moving into cash a bit more, and I'm sticking right around the same area. I'm about a third in cash. So I have to say there is a little bit of nervousness there for me. But the thing is that I just don't see us hitting a price shock where you get that, that 1 day, 2 day, 3 day, just, horrible drop. I just don't see that with my indicators. They don't look that negative. So at this point, I have pulled back just, in time with the fact that, we are pausing right now, and we are, I think, at a point where the market could turn down. So I'm sitting sort of in that neutral area right now. I know I came into the week as a bull, I'm pretty sure, for the Wall Street sentiment survey. If Mark's out there, he can correct me if I'm wrong. But I think next week, if we don't get a decent breakout back to test these all-time highs, then I would consider moving toward a more bearish stance next week out of a neutral position.
Now, the thing that bothers me, I guess, right now, and again, I'm a short-term trader, so my capital is precious in the near term.
Mm-hmm.
The thing that I'm a little concerned about, number one, we've had a huge run up, which I don't think anyone's going to dispute over the last 3 months. But we are approaching options expiration tomorrow, and there's a ton of in-the-money call options right now because we're sitting near the high. So anybody who's been buying calls for the last few months, sitting on a lot of premium or a lot of profits. And it's not surprising around options expiration Friday or just beyond to see the market pull back. And I'm just going to throw out 2 quick numbers. The 19th of the calendar month on the NASDAQ has an annualized return of minus 28.27% since 1971. And the 20th, of course, the 20th this week is going to be on a Saturday, but the 20th is minus 30.74%. These are the 2 worst days of the calendar month on the NASDAQ. And I think a lot of it has to do with that options expiration. So the fact that we've had this big run up, we saw all of a sudden out of the blue some big selling on Tuesday, and then we did recover back off of it. I'm not sure that we're quite out of the woods yet, and I would rather just be safe than sorry as a short-term trader. Now, from a longer-term perspective, I think the market goes higher. So I wouldn't be nearly as concerned. But as a short-term, I don't want to ride back down a lot of the gains that I've made recently. So that's why I've moved much more into cash.
There you go.
And with that, it is another wrap. I mean, we only have one more day this week. I tell you, the weeks just seem to fly by.
Well, here's our upcoming schedule. Tomorrow, I'm going to be doing a workshop on DP market indicators. It is Chart Watchers weekend, so get signed up if you're not already on that email list to get John Murphy, Martin Pring delivered right to your email box. And Scott Carney is going to be our featured guest next Wednesday. So with that, how'd we do? Answer that question for us and taking the survey.
We definitely would like to get that information from you. Also, thanks to everybody for tuning in, being with us today and every day. We certainly appreciate all the support you give us. And as Aaron mentioned, please remember to complete that survey as you exit. Love to get your feedback, what you think of Market Watchers Live, suggestions for future shows. If you have an idea for a segment, send it along. Who knows? Maybe we'll include it in one of our future shows. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. See you back here on Friday. Happy trading.